Hi there, and welcome to Jill's Quest for Riches. Now, in today's episode, I have some very cool news to share with you, namely that I finally reached a first milestone with my investment portfolio being a value of 50,000 euros. So I'm very happy with that. And in today's video, I will discuss why this is an important milestone and how I got there in the first place. Discuss a bit more about my portfolio and its returns. If you're ready, I'm ready. Let's go. So for the frequent viewers, you might see that I've changed a bit the decor or the setup. Let me know what you think of it. But now let's get into business. So why is 50K in value for an investment portfolio an important milestone? Well, it's actually more the 100K that is a big important milestone, and 50K means you're halfway there, but the most difficult half, the first half. But why is 100K so important? Well, many investors, including Warren Buffett, already mentioned oftentimes that reaching your first 100K investment portfolio is the hardest. Why? Because after that, actually the returns from your capital, from your investment, start giving some, let's say, a significant contribution to your further wealth building. You have to imagine if you have 100,000 euros sitting in investments, that gives a return of, if we're very modest, 4%, then you still get 4K per year extra. That's an extra month of salary that your capital is providing for you. So from that day on, when you reach 100K, you basically have 13 months of salary instead of 12 months of salary. And that's if you only reach those 4% returns. So your capital starts lifting some of the weight of your wealth building, and that's why 100K limit is very important. With that said, let's go to the portfolio. So this is a little bit personal, but here you have my stock portfolio. So you see the performance here of the last 30 or 31 days, and you see a big up, actually nearly 13% up, or 6,000 euros up since 30 days ago. So I'm recording this on the 4th of July, which is a Sunday. So last market day was the 2nd of July, and we're comparing this to the 2nd of June. Where I started at 49K, I'm now at 55.5K. All numbers here are in euros, by the way. Not all, but these numbers are in euros. So big bumps, very high return for one specific month, and that's mainly due to two very risky stocks that I have in my portfolio. So these are not a regular return, just to be clear. And I'll get into those two stocks, but here you see already quite an important jump that happened, I think, now about a week ago. But these are of course only the returns of 1 month. If we look at the last year, that's already a bit more interesting. There as well we have a more than 100% return, but this is a bit a skewed number because it includes some deposits, so that's just cash that I put into the account, so it's not a return, but we'll calculate them out of the equation later in this video. Apart from getting rid of the impact of the deposits, the cash deposits, it's also important to have a benchmark, compare with something, and maybe also to look a bit wider than only 1 year, because a good return this year but a bad return next year or last year might make a complete difference. So all of these we're going to look in right now, and to do so we are going a bit more detailed, and we're looking at the portfolio performance, where I can do a little bit more with my graph. So widening this up, there we go. So for example, this is just the last 7 days. So here we see I even lost 2.5K. With spending some time in the markets, with investing, I come to be able to live with such numbers, because sometimes it is frustrating that in maybe 1 day, sometimes you lose more money than you make with your job during a whole month. But as long as the positive days outrun the negative days, all is fine. So this is the last 7 days, which doesn't tell us that much. Let's put it on last month. And I've included here the S&P/X. It's a benchmark, Standard & Poor's 500, so the 500 biggest American exchange traded stocks, which is a very good benchmark for the American industry and for any portfolio performance. You should always ask yourself, okay, I have high returns, but how does this compare to a good benchmark like the S&P 500 to know, yeah, was it worthwhile, or should I just have put my money into an index without looking at it, not putting in any efforts, and have the same or a better return? Now, if we look at it on a 1 month scale, it's not that interesting. Let's put it on 1 year. Yeah, so this is probably a little bug in the system, since we're in the weekend that it puts the S&P 500 return of the last year on 0. So let's just go back a little bit. There we go. So S&P 500 over the course of 365 days, let's say, had a return of 37%, which is huge. The green curve here on this chart is the S&P 500. High returns, we've all seen it happening, so it's normal that my portfolio has high performance because everything went up, so also the things that I invested in. But what's nice to see is that my portfolio on itself had more like a 60 or let's say 55% return over the past year. So that's already quite different. It's quite a big difference. If you can maintain such differences over the long run, you become a rich man quite fast. But again, this is only 1 year, and a very good year for everybody, and a little bit better for me than let's say the American industry on average. So this already gives you a piece of the puzzle. One more important thing that I should have tackled a little bit earlier in the video, but also the method of calculating your return is important. You see here on the screen 2 switches, TWR and MWR. This stands for time-weighted returns and money-weighted returns. 2 methods. I'm not going to go too much into detail, but I will provide a link with more explanation and practical examples if you want to get deeper into it. But I'm opting for the time-weighted returns. Why is that? Because it is not impacted by cash inflows and outflows from deposits, which definitely happened. You see them here on the chart. So I deposited in March 2,500, and then in May another 5,000. I don't want those amounts to impact my return because they're not return. It's just a switch from a savings account to my investment account. I'm not making money at the point of switching that money from one pocket to the other, am I? So that's important. For people a bit more familiar with finance, the money-weighted return you can also call it the internal rate of return, IRR, which is very often used in finance. Now let's go even a little bit deeper, and we're looking only at the last year, but let's go from inception. So from the very moment that my account was created, which is not my first experience with investing, but let's say it encompasses the majority of all the investing I've done in my life. And it all started somewhere in 2016, October 2016, when I made my first deposit. We see it here on the charts. That was 3K that I deposited to start investing, and these are then the returns all throughout nearly 5 years. So what do we see here? The portfolio value today is 55K, which is enormous compared to the total amount of deposits I did, 35. That's 20K gain in value, which is huge. It means that if in 2016 I hadn't started putting some time and money into building up an investment portfolio, I would be 20K less rich than I am today, which in my opinion is quite a big impact. Now, I didn't invest a whole 35K from the start. These deposits came in over time. So there's even still, as I said before, 5,000 in May and then 2,500 in March this year. Looking at the returns of my investment portfolio since its very inception, we have this chart, so I'll quickly go over the legend again. So the blue line here is the returns in percentage on my portfolio. The green line is my benchmark, so the S&P 500. And then the bars, the blue bars here, those are the total value in absolute numbers, which you can see here. So 20K, 40K, and now we've reached 50K, even looking already direction 60K, whilst the return percentages are here. What you can also see on this chart is that most of the time the blue line, so my return, is higher than the green line, my comparison, the S&P 500, but not at every single moment. Over this period, blue line is lower than the green line. That's when I think mostly the big tech, so Google, Facebook, Netflix gained a lot of value, which brought the S&P 500 way higher, but I didn't have any exposure to these specific stocks, so I didn't take the same elevator, let's say. But later on, I caught up anyway. What you also can see in this graph is, of course, the flash crash March 2020, around this period, where both my portfolio as well as the market took a huge dip. As you can see, beginning of April, 2nd of April, I had deposited another 3,000 euros because I knew this is the moment to buy. Unfortunately, due to the crisis, I was very busy working and trying to save some jobs in my team. So I never ever got to put the time into selecting new stocks to purchase. So the markets went up again without me taking a real profit of it. So the 3K was there in my stock portfolio, but it was not invested. It was just liquid, which is a huge bummer. And to be honest, I had never expected it would recover that fast. And then my total returns over that complete period, here we have it, 114.15%. This is maybe weird because if you know 20K of profits on a deposit of 35K, it's not 100%, right? 100% would be 35K of profits. But this is because we use this time-weighted return. Most of these deposits happened in the later years, so they have a less big impact. There's two more things I promised you. One is to give you a view on which positions I have in this portfolio, and also where do these high returns of the last month actually come from. So let's do just that. Let's first go for the returns of the last month. So I'm putting a month to date and I'm looking here at the equities. So at this time, of these 55K, 6,000 is actually in cash. So nothing interesting to say there. 3.4K is in real estate, but this is actually one specific stock that invests in real estate. So it's one position. And then we have the equity. So here you have the ETFs, exchange traded funds. They represent a part of my portfolio, but the contribution of these returns to my total return, as you can see, is quite minimal. So we're looking here, my total return of the last month was 13%, and of these 13%, only 0.25 came from this ETF, and this one was even negative. The big returns came from Telix, this company, a pharmaceutical company that I bought a few years ago, and ever since has multiplied in price by, I think, 6. At one point I bought it, or no, not 6, maybe more 5. I bought it at 80 cents, I think, and now it's at 4.52. And then you have SPCE, which is the ticker for Virgin Galactic, which was a lot in the news lately. I've only bought this stock a few months ago. I discussed why I bought this one, because it was through a SPAC. I'm not a big fan of SPACs, but I bought it nonetheless, and bought it at 18, if I'm correct, and by now it has more than doubled. Part of that return was in the last month, which gave another 5% of my total of 13%. Now that's only in the last month. Let's look maybe a bit longer since inception, which positions have made the biggest difference. So here we see a position, Agias, that I've held from the very beginning. That was the first stock I bought in 2016. And I put 3,000 in there, and as you can see, it's let's say that it has had a 40% return. Why does it count for a 40% return in total? Why does it count for 25 of the 117? I had it for the longest time. So for a huge part of my portfolio, this was either 100% of the worth of the portfolio and 100% of the return, or then later on 50%. So this the returns on this stock count the most when you look over the total returns over the total period. Then in absolute terms, the biggest return came from Telix. Of course, as I said, it has multiplied multiple times. So here again, 46% of these 117% comes from my investment in Telix, and only 8.6% comes from Virgin Galactic. Even though it has doubled, I only have it since a few months. In any case, I bought it in 2021. So its impact on my total returns over the total lifetime of my stock portfolio is not that big yet. So I think those were the most interesting things I had to share about how I reached this 50K benchmark and what you could tell from my portfolio and its performance. If you have any further questions, don't hesitate to ask them in the comments. I just want to still point out very clearly, I do it every time, but I'm not a certified financial advisor. So none of the positions I have is necessarily a recommendation for you to also take this position. I think you should always make your own calculations. Everybody has their own risk appetite. I'm very aware that I'm taking quite a lot of risk in this portfolio, which I think is okay given my age. I'm only 29. In my head, I have a bit the idea like whatever I lose before 30, I can earn again after 30 anyways. So that's how I built up my investment portfolio, and probably that will also change over the years, and I will maybe go a bit more defensive, less aggressive, less risky with time. Hope you enjoyed this. Hope this video was interesting and informative for you, and see you in the next video. Bye.